Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're kicking off 2026's season of episodes. This is our inaugural one with some interesting observations, and then we'll talk about our normal things, the economy and markets. But wow, what a year 2025 was. We were not expecting that we would have such strength coming into the end of the year, that we'd be closing at all-time highs. We did. That was unexpected by many, particularly in light of the murky environment that we have regarding the economy. So, we're getting mixed signals about economic growth. We have a Federal Reserve that's been in the middle of a, rate cutting cycle, which we don't think, here at least, was necessary. However, so far inflation's remained moderately under control, and I say that I'll qualify that here in a little bit, but over the past weekend there was a notable development in that Chairman Powell came out and publicly made a statement asserting the importance of Federal Reserve independence out of, basically relative to Washington D.C.'s needs and wants. And that is something that we're pretty supportive of for a number of reasons. Mainly, the most important reason being that the intent and needs or desires of politicians are not always in alignment with the needs of the economy in terms of the management of economic growth, which is what monetary policy is designed to do. The Federal Reserve was actually created to be a check and balance against economic growth that was happening too quickly and with too much strength, or too weakly, or actually, declining. And so the Fed is actually designed to operate in opposition to the economy, to keep things from getting out of whack to the extent that we have boom-bust cycles like we have had in prior centuries. So, Washington is always going to have a desire for strong markets, strong labor markets in particular, lower prices being, a secondary concern of theirs, because they have the power of the purse through the Treasury to just create more money. And that's not always the best solution. In fact, that's what leads to inflation, and nobody wants to see that get out of control. So the Federal Reserve has that dual mandate, and in fact now they've been talking about a triple mandate, some of the Fed governors. But let's go back to the dual mandate, which is management of employment, the labor market and its health, and management of inflation. And arguably, the Federal Reserve has done an okay job with this, despite the fact that they've been under considerable pressure from Washington to keep lowering rates. And in our view, that's actually probably a counterproductive strategy, given that inflation is above 2%. So we're quite happy to see that the Federal Reserve is asserting its independence, although going forward we don't think that's going to hold, as a new Fed chairman comes in, or a chairperson comes in this year, who's probably going to be more in alignment with Washington, D.C.'s desires. So we may see the independence of the Fed come under a challenge despite that vocal statement. And, that potentially could lead to higher prices in the long term, an economy that's running hotter, quote unquote, than normally accepted views of sustainable economic growth. We've seen GDP growth numbers quite high over the recent years relative to our status as a developed world economy, where the long-term average growth rate that's considered to be sustainable is closer to 2%. We're seeing at times the economy growing double that. So in that type of environment, inflation is going to probably remain higher, regardless of what the Fed is doing from this point forward. And we're going to keep an eye on it. We're not in markets anymore where there is no inflation and interest rates are very low. The markets are actually returning to what we would consider to be a long-term normal condition, where the price of money, which is what interest rates are, tends to rise and fall, but tends to be overall on a higher level than it's been. It just has stayed in an artificially low level ever really since the great financial crisis. So we are entering what we consider to be a new era, and that has implications for markets. Just this morning we got CPI information in, which grew a little bit less, I suppose, than what the expected number was for core consumer price index, where they strip out volatile food and energy and things like that. That only grew by 2.6% on a year-over-year basis in the most recent period. That's December. 0.2% on a month-over-month basis. That's a little less than expected. Those numbers are still pretty high relative to the traditional target of 2% for inflation. So consumer prices rising by this is what we would consider to be quite a hot number, even though it's less than what the expectation was. We got some information later coming in the morning and in the afternoon from real estate market, in looking at the balance in the budget in the federal government. Tomorrow we get producer price indexes, and we like to look at this in conjunction with the consumer prices to get an idea about what's going to happen with corporate margins, or more accurately, what's been happening with corporate margins. So we're going to get that for November, which shows that, input prices, if we take producer prices as a proxy, are actually rising at a higher rate than they're able to raise prices to consumers. 2.7% to consumers, 2.9% on the core PPI. And so that suggests that corporate margins might be shrinking. In other words, corporations are making less dollars per widget sold, and that would argue that there's pressure on corporate profits that's coming into this year, which wasn't existing throughout the past several, while we were having a large advance in markets in the equity side. So yes, the equity market expectations for this year are a little bit lower than they've been in recent years. In part because of that, in part because we see a more challenging competitive arena. So we'll get more information on the real estate market, the labor market's coming in, which, let's talk about that. The labor market has shown pockets of weakness relative to what it's been in recent years. However, if you look at the long-term standards, we're not looking at a shrinking labor market just yet. Although last week we had a revision down in the non-farm payrolls report from a few months ago that suggests that the economy lost close to 200,000 jobs. So we want to keep watching that. If that becomes a pattern, potentially there is a slowdown in the economy beginning or already in progress. So we're watching that, but we haven't seen enough evidence to make that call yet. That was supportive of the Fed's rate cutting cycle, though, that one data point that was just pointed out. We'll get information on the leading index, and then GDP coming in. And look, here we go. This is forecast, third quarter GDP, forecast to no revision, 4.3%. That is more than double what is normally accepted as long-term sustainable growth in a developed world economy such as the United States. So that suggests that we're running very hot still. And this is a data point that calls into question whether the Federal Reserve is on the right track by cutting rates. We get more labor market, we get sentiment indications, and then, a little bit on, construction spending to round it out over the next couple of weeks. So what is the message from all this? It's mixed. The economy is doing well in some areas. It might be decelerating in some other areas, but overall seems to be relatively healthy. Calling into question whether we need to be, in this lower rate environment, or considering, adding to that by another rate cut, which market participants are now discounting a bit in the interest rate futures markets. The equity market closed the year out last year at all-time highs, and we're continuing to push higher. The market climbs a wall of worry, and it goes down the slope of hope. So with all of these concerns out there, we're actually, in an environment where we expect the markets to continue to trickle up. However, we don't expect this slope of a curve. We expect things to happen more slowly, in a more measured fashion as we go into this year. And because of all of this, data that's been coming in mixed, and because the markets have taken this relentless climb, a pause is actually healthy. If we were to see sharply accelerating prices in the equity markets, that would be indicative that volatility was probably likely to increase in the near future. And we don't want to see that going into a new year. We expect a more volatile environment to happen at some point this year because business conditions have just gotten a lot more challenging. And if the continued pressures on corporate margins are present, you're going to see signs of clear winners and losers. and we could see volatility return to the markets. So we'll come back to this in a moment. Interest rates. So here's something that's actually interesting, pardon the pun. On the yellow curve, we have the interest rate yield curve on treasuries as of September 17th, which was the day prior to the latest rate cutting cycle. This is actually a very good thing. We've seen the short end of the curve come down, and we've seen the longer end where this is confusing to some investors. They don't understand, and so we want to highlight this. Basically, at the 2-year point, the rate curves converge. This is today in green. The gold is, September 17th. And people are confused as to why interest rates 2 years and out are now higher than they were at the beginning of a rate cutting cycle. That doesn't make sense. They've lowered interest rates, they've lowered the price of money, but when they do that, that's considered to be inflationary, and an input to how yield is priced on the treasury curve, in fact, the only input is inflation expectations. So out 2 years and further, well, a little bit further than 2 years, somewhere between 2 and 3, we are actually anywhere between 6 and 14 basis points higher than we were at the beginning of the cycle, because that inflation risk premium, it's called, has gone up, and therefore the yield that an investor is going to require to loan the government money for 10 years or 20 or 30 has gone up commensurately. So we're continuing to watch that, but it is worth noting that this shape of a yield curve is considered to be healthy and normal over the majority of history in terms of our economy and in terms of financial markets. So we're actually quite happy to see this happen. We've been in abnormal conditions for a number of years prior to this, so that's a good development. And then we have here the yield curve for A-rated corporate bonds, which have come down slightly over the past month. But if I plug in here again, the day before the cutting cycle, you see it's the same situation. Yields are markedly higher than they were prior to that, and that's because of the inflation situation getting priced in. Corporate bonds also, in terms of pricing their yield, have the default risk premium, which is also rising. That's why we see for similar yields or similar maturities, the yields are differently, they're rising at a different rate. So the 10-year paper on treasuries is 9 basis points. It's 14 for corporations, and that's because the default risk premium is also rising at the same time inflation risk premium is. So that suggests there's more risk in corporate America. And it's worth watching, although the spreads, the difference between a corporate bond and a treasury bond in yield, are very near historic lows. So we don't see a lot of stress in the corporate fixed income markets either. The S&P 500 is going to continue to do its thing until it doesn't. We don't know when that is. We know that there's pressure on earnings. We know that there are going to be changes to, who's winning. We've already seen that. Technology saw a pretty large rotation out at the end of 2025. And as a result, S&P performance is flattening out across all of the industries, and thereby coming down a little bit lower. But for the long term, what are the implications? Well, it's the same thing we've always said. We got to stick to our long-term plan. And, we're not worried when the markets are doing this, and we're not overly excited when they're doing this. We're just going to keep plugging away at a good long-term plan to achieve our financial goals. Our goal is not to have the market exposure, it's to achieve our financial goals. And if you have questions about your portfolio, questions about the economy, give us a call. We're happy to talk. Hope you found this useful. Have a great day.